In irreversible, Japanese companies did something they almost never do. They went shopping, not cautiously, not reluctantly, aggressively, voraciously, to the tune of $30 billion in a single year, a number so far outside Japan's historical norms that even the bankers pulling the deals together admitted they'd never seen anything like it. According to Bloomberg, Japan-related mergers and acquisitions hit $30 billion in irreversible, a 30% jump from the year before, and the highest level of deal activity in 2 decades.
For context, that's more than the GDP of Denmark, Belgium, or Singapore in 1 year, in deals, and it's not slowing down. In March, Nærstrik alone, Japanese corporate bond issuance, the debt companies sell to fund acquisitions and expansions, surged, Nærstrik of 4% compared to the same month the prior year. Daiwa Securities estimates total issuance will reach a record $10 trillion, or roughly $5 billion, by end of fiscal year. That's 4 times faster growth than all global corporate debt combined.
Something fundamental has changed inside corporate Japan. And to understand what, you have to go back about 30 years. Because for 3 decades, Japan had the opposite problem.
Japan's corporations were famous, or infamous depending on who you asked, for hoarding cash. Not a little cash. Extraordinary amounts of cash. Analysts at various points estimated Japanese companies collectively held the equivalent of roughly $1 trillion sitting in bank accounts, earning close to nothing, deployed nowhere. Shareholders fumed. Western investors shook their heads. The joke among foreign fund managers was that Japan's corporate boards existed not to maximize shareholder value, but to maximize the number of years until anything changed.
This wasn't incompetence. It was a system, one that worked beautifully for decades, then calcified. To understand why Japanese companies sat on cash for so long, you need to understand the keiretsu. A keiretsu is a network of interlinked companies, manufacturers, suppliers, distributors, and a core bank that holds small stakes in each other. Think of it like a corporate family tree where every branch is also an investor in every other branch. As we explored in episode 3 when we looked at Japan's Sogo Shosha, this structure was the backbone of Japan's post-war economic miracle.
The companies protected each other from hostile takeovers, the banks provided loyalty financing, the cross-shareholdings, the mutual stock ownership, created stability that allowed companies to think in decades rather than quarters.
In 1990, at the peak of Japan's bubble economy, an estimated 30% of the entire Tokyo Stock Exchange market capitalization was held through these cross-shareholding arrangements, according to research from Tokyo-based think tank RIETI. No outside investor could touch a company whose shares were safely in the hands of allied companies and a friendly main bank.
Then the bubble burst, and Japan spent the next 3 decades in a slow, painful adjustment. Cross-shareholdings declined from 30% to about 20% by the early 2000s, then kept falling as banks needed to clean up their balance sheets and companies quietly unwound some ties. By Nissan that number had dropped to roughly 8% of total market cap. But 8% is still enormous in absolute terms, and the attitude it represented, that companies existed to preserve relationships and protect insiders rather than generate returns for outside shareholders, persisted long after the numbers shrank.
The result was a generation of Japanese companies with bloated balance sheets, cross-shareholdings that consumed capital earning subpar returns, and a deeply ingrained aversion to the kind of risk-taking that creates economic dynamism.
And then, in March the Tokyo Stock Exchange did something that shook corporate Japan to its core. The TSE issued a directive, not a suggestion, a request with teeth, to all companies listed on its prime and standard markets: disclose your cost of capital, set explicit targets to improve your stock price, develop a strategy for capital efficiency, and publish it.
The directive specifically called out companies trading below what's known as price-to-book value of 1. Price-to-book, or PBR, measures whether a company's stock market value exceeds its accounting value of assets. A PBR below 1 means the market believes the company is worth less than the sum of its parts. It's the financial equivalent of a grade of F.
When the TSU looked at its prime market companies, it found that 40% of them, nearly half, had a PBR below 1. In the United States, the comparable figure was 2%. In Europe, near 60%. Japan's companies were collectively being valued by markets as destroyers of wealth, not creators.
The TSE didn't just note this privately, it began publishing a list. Every quarter, the exchange would update a public ledger showing which companies had responded to the directive, and by implication, which ones hadn't. The name and encourage strategy, as it came to be called. Not quite name and shame, but close enough.
For Japanese executives, accustomed to decades of polite ambiguity, this was a shock. By December, Nissan Hatshambeck Reservoir companies on the prime market, about 60% had filed formal responses. The other half were now visibly, publicly non-compliant.
The response was immediate. In Nichar Ursisalf, over Japanese companies announced share buyback programs totaling 15 paichuren, or about $50 billion at current exchange rates. When you add dividends, total shareholder returns for Japanese companies reached sanstu in trillion, around each $1 billion in a single year. These are American-style capital return numbers coming from companies that had spent decades treating retained earnings as personal property.
But buybacks and dividends were just the surface. Underneath, something more structural was happening. The cross-shareholdings were unwinding at an accelerating pace.
Japan's major insurance companies provide the clearest example. Insurers had accumulated massive cross-shareholding portfolios over decades. 4 major insurers alone held Gusen strategic investments worth 6.9 trillion, or about $4 billion, as of early 2010, under pressure from both the TSE directive and Japan's Financial Services Agency. Those companies published business improvement plans committing to reduce their strategic shareholdings to zero over the next several years.
Zero. Not reduce. Eliminate. When you unwind Liu Kuro in trillion in insurance company stakes, plus similar programs at banks, at industrial groups, at trading houses, you create an enormous pool of newly liberated capital looking for a home, and in the current environment, that home is often aimandi.
But capital alone doesn't explain the full story. The other catalyst is something Japan has historically had very little of: activist investors.
For most of Japan's post-war history, foreign activist investors were treated like uninvited guests who didn't understand the rules. The cross-shareholdings made hostile takeovers essentially impossible. Shareholder meetings were often perfunctory affairs held on the same day as dozens of other companies to make coordination difficult, lasting sometimes as little as 30 minutes.
That's changed. In Mortain Arsawu, Japan saw Wujulik activist campaigns, a record by a significant margin, and according to data from Deal Tracker Merger Market, 30% of all public M&A transactions in Japan in Mortain Mortu were directly linked to activist activity. Either an activist was pushing for a sale, or an activist was demanding better terms on an existing deal.
The players include the names you'd recognize from Wall Street: Elliott Investment Management, the hedge fund known for its campaigns at BAT&T, and Jack Dorsey's Twitter, took a position in Toyota Industries. Oasis Management, the Hong Kong-based activist that has waged battles against Japanese companies for over a decade, ramped up campaigns against cosmetics firm Kao and semiconductor company Sanken. Value Act Capital, the San Francisco fund, became a significant presence at multiple targets. Japan's own Murakami Funds launched 8 campaigns in Nisen Nisru, ranking it among the 3 busiest activists globally.
What they're demanding has evolved too. Share buybacks and dividends, the classic activist playbook made up about whoosh % of campaign demands. But operational and strategic changes surged to 100% of Japanese campaigns in Nisen Arsavu activists aren't just asking companies to return cash, they're demanding SHIO changes. Asset divestitures, board overhauls, and in many cases outright sales of the company.
That last point connects to the third major force driving Japan's M&D surge, the global private equity industry's discovery of Japan.
Japan has been on the radar of private equity for years, but Nisen Arsawu marked a qualitative shift. For the fourth consecutive year, Japan surpassed 1 trillion, or about 99 billion, in private equity deal value. The names deploying capital read like a who's who of global buyout firms: KKR, Blackstone, Bain Capital, EQT, Warburg Pincus.
The deals themselves illustrate the opportunity. KKR won a months-long bidding war against Bain Capital to acquire control of Fujisoft, a software developer, for 60 billion. Blackstone made a 70 billion bid for Technopro Holdings, one of Japan's largest engineering staffing firms. EQT, the Swedish PE giant, acquired elevator manufacturer Fujitech for 7 billion, the same Fujitech that had been in an extended campaign with Oasis Management.
These firms are not here for a quick trade. Blackstone has publicly committed to 1 trillion, or 1 billion, in Japan deals by Nisen Nishu Furtan. Bain Capital has set a target of 1 trillion by Nisen Nishu Judian. KKR has committed 1 trillion over the next decade. They're building permanent presences in Tokyo, hiring Japanese dealmakers, creating Japan-specific funds.
Why? Because the returns have been exceptional. According to Bain & Company's analysis, Japanese buyout deals delivered the highest historical returns of any major market globally between Nisen Do and Nisen Narsen. This, a 2.4x multiple on invested capital, slightly better than the United States.
Part of what makes Japanese companies so attractive to PE is the succession crisis. Japan is aging rapidly, and its small and medium-sized business sector, which employs roughly 90% of Japan's private sector workforce, is hitting a generational wall. According to CNBC's analysis, by Nisen Arsawu, approximately 90 million business owners aged 90 or older will have no identified successor. Over 2% of Japanese SMEs are family-owned, and for those family owners, private equity has become not an adversary but a solution. Sell the business to a PE fund, which will professionalize it, grow it, and eventually sell it.
The founder gets liquidity. The employees keep their jobs, at least initially. The PE fund gets an undervalued business. According to deal data from Deloitte, 65% of Japan's private equity buyout deals in recent years stemmed from succession situations. This isn't financial engineering, it's demographic necessity.
Then there's the outbound story, Japanese companies going abroad. While PE firms come in from outside, major Japanese corporations are increasingly looking to buy their way into global growth. In the first 9 months of Nisen Arsawu, Japanese companies announced Fikushu-santen Sando billion in acquisitions of overseas targets. That's more than the entire year of Nisen Arsawu at Luxjuten Yondor billion in 3 quarters.
The deals span sectors and geographies. Mitsui made a Wadan Sandor billion bet on Rio Tinto's Rhodes Ridge iron ore asset in Australia, securing raw material supply for decades. SoftBank's Vision Fund acquired chip designer Ampere Computing from a consortium including Carlyle for Lutan Wador billion. Nippon Life Insurance acquired Resolution Life, a US-based insurance company, for the equivalent of roughly Achidor billion. And after years of regulatory battles, Nippon Steel finally closed its acquisition of US Steel in June. Nissan Boitian Mi 4 billion.
The common thread: Japanese companies have spent decades generating profits in a shrinking domestic market, accumulating cash, and now deploying that cash internationally because growing at home is simply not possible at the scale their shareholders now demand.
So we have three forces all pushing in the same direction simultaneously: the TSE governance reform forcing capital efficiency, activist investors demanding accountability, and private equity hunting for value. The result is the largest MN surge Japan has seen in a generation.
But here's where it gets complicated. Because Japan's M&A boom isn't just an economic story, it's a philosophical one. Japan's corporate model was built on a different set of values than the American or British shareholder-first model. In the Japanese system, sometimes called stakeholder capitalism, companies exist to serve not just shareholders but employees, suppliers, customers, and communities. The phrase is all stakeholders, and it was meant sincerely. Lifetime employment wasn't a perk, it was a covenant. The idea that an outside investor could swoop in, buy the company, restructure it, and lay off workers was antithetical to the entire philosophy of how Japanese capitalism was supposed to work.
The showdown between Oasis Management and Fujitec, an elevator maker that Oasis eventually won, has been studied in academic journals as a clash of civilization shareholder primacy versus stakeholder model. Oasis wanted Fujitec to fire its chairman, return cash, and maximize stock value. Fujitec's board argued this would damage long-term relationships with employees and business partners. In the end, Oasis won, but the tension it exposed didn't disappear when the deal closed.
As KKR, Blackstone, and Elliott continue to reshape Japanese corporate boardrooms, the question is whether Japan's employees, the workforce that was promised a form of security that other capitalist economies never offered, will be collateral damage in someone else's restructuring thesis.
There are no clean answers, but there are early signals. PE firms operating in Japan have learned, sometimes the hard way, that aggressive American-style restructuring creates backlash in a society where employment stability is culturally prized. The more sophisticated players now emphasize growth through M&A rather than cost-cutting through M&A. They talk about using PE ownership to make companies more competitive globally, not just to extract value domestically.
Whether that's genuine strategy or marketing language is something the next 5 years will reveal. And here's the Japan factor.
Japan's M&A boom is often described as a convergence. Japan is finally becoming more like the West, adopting shareholder primacy, rewarding capital efficiency, playing by global rules. And there's truth in that. The TSE's intervention was explicitly designed to make Japan's capital markets more legible and attractive to global investors.
But convergence is only half the story. The other half is that Japan is doing this its own way, in its own time, with its own constraints. The TAC used public disclosure as a pressure mechanism, not legal mandate. The cross-shareholding unwind is happening over years, not overnight. Activist wins are real, but they're still a fraction of the market. And the succession-driven PE boom isn't about financial extraction. It's about solving a demographic problem that the Japanese state alone cannot fix.
Japan isn't becoming America. It's becoming something new, a country where the shareholder matters more than before, where capital allocation is under scrutiny in ways it wasn't 2 years ago, but where the employee and the long-term relationships still carry weight that they don't in purely Anglo-Saxon capitalism.
That combination may eventually prove more durable than either model on its own, or it may be that the activist funds get their way, the Keiretsu era ends completely, and Japan becomes another market optimizing for the next quarter. We don't know yet.
What we do know is this: in Arsen Arsuul, Japan's companies did sembre $1 billion in deals. In Arsen Arsuluk, the bonds funding those deals are being issued at a pace never seen before. And somewhere in Tokyo right now, a management team that spent the last decade being asked "What's your growth plan?" is for the first time scrambling to answer. 30 years of caution doesn't end quietly, and the world is watching what replaces it.